Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. In this video, I want to look at a particular liability that is very commonly incurred when you're looking at a set of financial statements. I always believe that one of the main reasons for taking a financial accounting class is so that you can pick up a set of financial statements and you can have a relatively good understanding of what you're seeing. So I want to look at a particular account today that shows up very often on financial statements. It is the liability deferred income taxes or deferred income tax liabilities. What does it mean? Where does it come from? What does it tell the decision maker about the company? Before I get ready to actually talk about deferred income tax liabilities, I want to make a distinction that is often bothersome for my students in my classes. And that is the difference between US GAAP and the Internal Revenue Code that sets the income tax laws. A lot of students come into a financial accounting class and believe what they're learning are tax laws, but that's incorrect. US GAAP, as you and I both know, is the rules that have been created for financial reporting. The formal rules for reporting financial statements, a balance sheet, an income statement, and so on, come from what we refer to as United States generally accepted accounting principles. Those principles, those rules, are created by the Financial Accounting Standards Board, which is also known as FASB. What is the goal of those rules? When they create a rule, what do they want that rule to do? They want the financial statements that people look at to be presented fairly in all material respects. So they're looking for a fair representation. So if you're looking for a company and you look at the financial statements, the rules of accounting, US GAAP, are supposed to provide you with a fair representation of that company, its futures prospects, and its financial health. It allows the auditors then to say that they are presented fairly in all material respects. We've talked about this before. It provides you with financial statements that you can trust. What is the purpose of all of this? The purpose is so that decision makers, and that's the role that I assume that you will play, can assess the financial health and future prospects of that organization and therefore make a wise decision about the organization. You can take the financial statements, you know what US GAAP has said, how US GAAP has created those financial statements, and that will help you to get a fair representation of the company and therefore to make wise decisions about that company. In my mind, US GAAP is a tremendously important set of rules. Without it, it would be almost impossible for anyone to truly understand what they were seeing when they looked at a set of financial statements. So if you're in a financial accounting class and you're talking about US GAAP, you're talking about the rules for financial reporting so that decision makers can understand the company, the organization, and make wise decisions about that organization. That is entirely different from the Internal Revenue Code. The Internal Revenue Code is the income tax laws, has nothing to do with financial reporting. It is the income tax laws specifically in the United States. Every country has their own set of income tax laws. The income tax laws in the United States are found in the Internal Revenue Code. They are created by the United States Congress. There is no FASB-like organization. The rules that make up the Internal Revenue Code come from our Congress. Now, they are assisted by a couple of other bodies. The rules are implemented by the Internal Revenue Service. They take what Congress has written and they help to implement that. So on a day-to-day basis, people and corporations can pay the amount that they owe. It's also interpreted by the tax courts. So if you're talking about a set of tax laws, that can be extremely extensive. The Congress will write the laws. They will be implemented by the Internal Revenue Service, and the tax courts will judge them and work on them to make sure that they're interpreted correctly. Now, what is the purpose? Remember, for US GAAP, the purpose was solely to have financial statements that were presented fairly so outside decision makers could make wise decisions. Notice that does not come into play at all for tax laws. They have an entirely different set of purposes. First of is the obvious. Tax laws are set up so that the federal government can generate revenue. If you're going to have an army, if you're going to have all of the things that the federal government provides, you need revenue. And then income tax laws help provide those revenues. But that's not the only reason you have income tax laws. In a second, and what is often very important, the income tax laws provide the government with a method to manage the economy. If the economy, for example, is running too fast, if there's a lot of inflation, if things are heating up, then the government can slow down the economy a little bit by raising the tax laws, raising the tax rates, and taking money out of the economy. On the other hand, if the economy is running sluggishly, if the economy is not doing very well at the present moment, then Congress can reduce the income tax rates, and that will allow people to have more cash in their pockets, and that will help to raise or speed up the economy. So the government certainly needs money, but it also needs a way that it can provide assistance or manage the economy and help it speed up or slow down. And I've given two examples there. You raise the tax rates or you lower the tax rates, but there's lots of places within the income tax laws where you can manipulate the economic situation and help the government run better. Lastly, and very importantly, the income tax laws allow us to address the needs of our society. There are many, many tax laws that are written purely to help some element of society. For example, an individual can often get a deduction if they have a lot of medical expenses. Why? Because the government feels that that element of society needs help. Individuals can get a deduction if they give money to charity. Why? Because the government feels that that element of society needs assistance. If you adopt children, you can get a tax credit. Why? Because the government feels that that would be a way to help a member of society that needs help. So if you're looking at the tax laws, we often think about them raising money, but they also give the government a way to manage the economy and also to help elements of society that they believe need assistance. One of the reasons that the income tax laws can be very complicated or maybe very complex is that they don't have one purpose, they actually have at least three purposes. Now that means that if you look at the income tax, the income tax rules and US GAAP, they are two entirely different set of rules. They are the same in some few places, but they're different in many places. A lot of times people will look at the income taxes and the GAAP and say, well, they ought to be the same, but they have different purposes and they're created by different bodies. So you have over here a set of rules called US GAAP. And US GAAP evolves all the time based upon changes in the business world. Over here, you have a different set of rules called the Internal Revenue Code and its interpretations and implementation. And they will be rules over here that the US government will manage. Do these rules and these rules have to be the same? Oh, in some places they are exactly the same. That's not uncommon. But there are plenty of times where one rule over here, we'll say this is rule X over here, is actually rule Z over here. It's a different type of rule. There is a different rule in play in that case. There's nothing wrong with that. You'll often hear people make jokes about two sets of books. Well, you have to have two sets of books, one according to US GAAP and one according to the tax laws, because you have two sets of rules. Now, what that means then is that there will be differences between what you have on your financial statements and what you have on your tax returns. If you have two sets of rules, you're going to have two sets of reports. So if you look at the income statement for a company and you look at its tax return, you may find all kinds of differences. And the reason is the rules are different. You're supposed to find things like that. Okay, so what we find out then is that because of these differences, taxpayers, and this can be a corporate taxpayer or an individual taxpayer, will try to make use of these differences to delay tax payments. They will make every attempt, whether it's an individual or a corporation, to put off paying their taxes. Now, why do they do that so, with such diligence? Why are they working so hard to put off paying their taxes? Taxpayers can make use of that money for a longer period of time if they're able to delay their tax payments. And what they do then is, if they delay the tax payments, they use that cash to generate additional profits. So if you could put off paying $1,000 for a year because you delay the reporting of the income on your tax return, then you could use that $1,000 to make more money. And companies are in that business. And just as an example of that, and I looked this up on the internet just this morning, if I look at Visa, the credit card company, for the current year, they reported a deferred income tax liability, meaning that they had put off paying their tax of $5.2 billion. Can you imagine how much profit you could make if you could hold on to $5.2 billion for an extra year or two? Well, that's what Visa, in a very normal situation, has done. They have delayed paying $5.2 billion of their income taxes. And the reason they did that was they wanted to continue to use that $5.2 billion for an extra period of time. If that was a year or two or three, they could make hundreds of millions of dollars off of that money. But once you pay it to the government, it's gone. Once you send that check in, it's gone. So if you can delay the payment, that gives you a chance to use the money more often. Now, what I would like to do is to give you an example of this. And a fairly easy example is what we call the installment sales method. And the installment sales method is rarely used in US GAAP. It's just not a method that you see used very often in US GAAP, but it's used all the time in the income tax rules. It can normally be used when you sell something, you collect the money over a period of time. So I want to give you an example of how a company could use the installment sale method to delay their income taxes, and therefore how that would show up in their financial statements. So what they're going to do then is, according to US GAAP, if you have a sale, and we covered this early in the textbook, if you have a sale, you record the sales transaction when the performance obligation has been satisfied. So as soon as you've satisfied the performance obligation, the revenue is reported right then. Now, if you're using the installment sale method, in other words, if you sell something and you will not get the cash for a while and you apply the installment sale method, then the tax laws say that you can report that, or you can wait to report that until the cash has been collected. So if you make a sale here and 3 years later you collect the cash, normally, according to US GAAP, you would record the income off that, according to US GAAP, when you make the sale, or at least when the performance obligation is satisfied. According to the tax laws, you can wait until you collect the cash to report the income. So if this is year one, you report the sale in year one. If this is year four, then you report the sale on the tax return in year four, which means that you put off for 4 years the payment of the income tax, and you made a profit off of that. Interesting to record that. So the difference in these two would create a deferred income tax liability. That's what Visa is reporting on their balance sheet under their liabilities, that deferred income tax liability. I want to make a comment just from a theoretical perspective. Normally, the rule we've learned for liabilities is that it has to be a probable future sacrifice of an asset or service. It has to be a present obligation created by a past transaction. We learned that early in the book. And if you have a liability, then you see if it meets those 4 benchmarks. And if it does, it's normally reported as a liability. Here, you report a deferred income tax, but there is no present obligation. There is no obligation until you collect the cash. So why is this reported as a liability? And the answer is, which is always going to be the answer, is that that's what FASB tells you to do. FASB can actually set up its own rules. So even though a deferred income tax liability doesn't theoretically meet the rules for a liability, you still have to report it as a liability, because according to FASB and US GAAP, that's what you have to do. So in this case, if they sell this property in year one, then between year one and year four, they will have to report a deferred income tax liability. And again, that's exactly what Visa is doing when they report that large amount of deferred income tax liability on their balance sheet. Now we need an example of that, I think. I think we need to show you how that actually works. So let's assume that Ace Company sells a large parcel of land on December 31, year one. And we're going to assume that everything that happens on December 31, year one, except they're not going to collect the money. They sell this land and they generate a profit of $5 million. So therefore, assuming the performance obligation is satisfied in year number one, they will have this $5 million gain on the sale of land. However, Ace will not collect any of the money until year three. They set the transaction up so that it will not require any payment of cash until year three. When it does, we'll assume the tax rate is 20%, just to have a rate to assume. So that means that in year three, they're going to have to pay the entire $1 million. They'll get the cash in year three. They'll get the cash in year three. So therefore, they'll have the $5 million gain in year three. The tax rate is 20%. So therefore, they'll have to pay $1 million. The sale took place in year one. The cash is going to be collected in year three, so they don't have to pay the tax until year three. For that reason, they'll report a deferred income tax liability at the end of year one, and they'll also, because it's not going to be paid until year three, they'll also show that same liability in year two. So why do they have to do that? Because the books have recognized the gain in year one, but the taxes won't be paid until year three. In the interim, they have to report a deferred income tax liability. Every company faces this. Every company has to report these deferred income tax liabilities. Why? Because they have used the installment sale method. And why did they use the installment sale method? Because they wanted to put off the payment of the $1 million. That was the whole purpose of using the installment sale method. So on December 31, year one, they will say, okay, we have a $5 million gain on the sale of the land. The tax rate's 20%. So therefore, we're going to have an expense And they call this an expense deferred of $1 million, and that creates the deferred income tax liability. You don't actually owe anything yet, but you will owe the $1 million according to the installment sale method in year 3 when the cash is collected. That's the entry that companies like Visa make all the time. And they have an income item in 1 year, and they will delay paying the income tax until a future year. And that creates, according to US GAAP, a deferred income tax liability. So whenever you see an income statement, you know it's according to US GAAP. Whenever you see a tax return, it's according to the Internal Revenue Code. Companies every day will use the differences between those two sets of records to push off or delay the payment of their income taxes as long as they possibly can. But when they do that, they still have to report a deferred income tax liability for the amount that they are delaying. And that's why so many companies have such large deferred income tax liabilities. My name is Joe Hoyle. I'm one of the co-authors of your financial accounting textbook. This is a look at one of the most common liabilities you'll ever see, deferred income taxes, but only if you've taken a course like this will you understand where it comes from. It comes from delaying the payment of your income taxes. Have a great day.